Right, guys. Hello. Good morning. So, we're carrying on with our videos on um, chapter 18, and so far we have, if you like, consolidated two companies, parent and subsidiary, where everything is relatively, when I say relatively straightforward, just to understand the mechanics of it. If you like, working 1, working 2, working 3, working 4, and working 5. So now we start having a few things to think about and adjust, if you like, that are not quite fully straightforward, that we have to just sort of do. The key issue here is this issue of fair value. And really, in terms of, when I say fair value, the standard, IFRS 10, requires us to recognize, in fact, throughout this whole study, where our aim is to make sure we recognize all the assets and liabilities we're dealing with at fair value. That's the first thing. And really, this question of fair value applies even, as you can imagine, to goodwill. We'll come to see where, if you're investing, if you're buying something, we need to find the fair value of what the subsidiary is. And just because it says A minus L is equal to, this might be 100, this might be 30, and equity says 70, this might not be the fair value. This is just the value of the, if you like, the physical assets in place. So the idea of fair value is important. So the first problem, of course, is because now you must kind of have gone through the earlier videos, if you like, on the first lecture, and our first focus is on goodwill. You see, because typically earlier to this, we just thought the idea was that you could just pay for goodwill, if you like, with cash, if you like. So typically consideration was always just money, if you like, but that's not always true. So you could debit investment usually and credit bank. That's what we've always said. But what we're actually saying is, no, we can credit a range of other things. We could credit shares. So we could pay for the part in a different company by issuing our shares. Very, very, very normal. We could pay for our shares in a subsidiary by offering to pay shares or to pay money in the future. Either we could do that, deferred shares, or even deferred finance, or even deferred money. So all you have to do is you have to just look and read the question to see which one is it. You could do a combination, if you like, but it must be at fair value, which means that if you choose to pay something in the future, we must recognize its present value today in the statement of financial position. This is irrelevant of this of consideration. This would be on any scenario, if you like. And I think in class I might have discussed the idea of taking out a loan. When you take out a loan, you're ultimately saying, okay, or if you buy something on credit, for example, you take out a car on credit. You take the car now and you say you will pay something in the future, the amount. What we work out today is the present value of that loan. And if you like, right, every year add on the relevant interest until it becomes the full amount, and then we pay it off in that period. And that's what we're trying to do here, right? So ultimately, we can't recognize the future amount in our accounts. We need to recognize the present value, because that tells us the real total of what the value of that investment is, right, by recognizing today's amount. So let's look at the objectives. Our aim is to ensure that the right amount is calculated for goodwill, because if we get consideration right, then we can get goodwill right. The consideration paid for the subsidiary must be accounted for at fair value. The subsidiary's identified assets and liabilities must be accounted for at fair value. So we need to go in and see if there are any assets and liabilities that need to be updated. Yeah, and IFRS 13, forgive me, not 10, there's so many of them, guides us on the fair value measurement, the price that would be received to sell an asset or paid to transfer at a measurement date that defines it. And again, we discussed last time when we in the earlier videos when we looked at consideration. Remember, the real format for working three is what is the consideration by the parent? Maybe that's 80%. Add in the fair value of the non-controlling interest, that's 20%. So we now know what the full value is of the business, and take away the physical assets of the company, of course, and that we get this from working two. So because it's at 100%, so we can now find out what the real full goodwill is, and this goodwill belongs, if you like, to both the parent and the subsidiary. And you can see here, this is what I was talking about, consideration. This could be cash paid, if you like. So this is the new complication. The new complication is it's possible to have cash paid at acquisition. It's possible to have other forms of consideration, deferred contingent considerations, share exchanges, but there's nothing special. You just have to kind of watch it carefully. And of course, there are other costs we might have to pay, but these get written through the consolidated income statement, so to speak, or the profit and loss account as they happen, and are not capitalized, right? Because really we're talking about capitalization here in terms of debit investment. So the argument is it debit investment or debit expense, ultimately, with legal fees and accounting fees. Right, let's carry on. And that is what I was saying here, deferred consideration. Now, I'll make these in short 10-minute slots, so that's fine. I'm not in any rush. I want to make sure we're clearly happy. Deferred consideration should be measured at fair value at the date of acquisition, if you like. And the fair value of any deferred consideration is calculated by discounting the amounts to present value. I'll go through an example in a second. And any contingent should be measured at fair value. Always measured at fair value. Here we are, taking into consideration the time value of money. Again, the key point here is that we should be measuring it at the fair value of money. And this is the formula, if you like, that you need. Now, when I say formula, really what we're saying here is that imagine you had to pay, let's pick a figure, I'll pick a round, it literally does not matter. Imagine you had to pay 1,500 or 15,000 in 3 years' time. So we are at today, this next year, and then here we are, T3. If interest rates, for example, in the bank are 10%, what we're really asking is, if you had to pay this in 3 years' time, what is this value? What is £15,000 worth, if you like, today? In other words, what do I put in the bank today that if I leave it in the bank, it will gain 10% on top of that, and then whatever's left, if you like, x plus 1 plus 10%, and then it gains another 10% on that. I leave it in the bank, it gains another 10% on that, and it finally arrives, if you like, at 15,000. So let's kind of do it again to sort of see where I'm trying to ultimately get to, just to show you the process. Excuse me. So what am I saying? There has to be a certain amount. I'll put it in here, and then I multiply. So let's assume. So what I'm going to do is that I can't know what it is. So I mean, I don't know what it is by guessing. So I know that if I go backwards, if I divide 15,000 by 10%, if you like, by 1.10, so to speak, divided by 1.1, I will get 13636. If I divide this again by 1.1, I will get 12396. And if I divide this by 1.1, I will get 11269. So what am I saying? If I leave 11269, I just picked these numbers randomly, which is why I've had to sort of work them out. If I leave 11269 in the bank, today, and the interest rate is 10%. Multiply 10%, find 10% of this. If you find 10% of that, of course, that is 1126.9. And I leave this in the bank. Of course, this will add on to this, of course. And if I add this together, you will have 11269 plus 1126.9. And of course, you will get 12396, which is what we have here. If I leave this again in the bank, I will now have another 10% on this. I will have 1239.6. If I leave this in the bank for a year, I will have 13636. And for the final time, if I leave it in the bank for the last year, 10% on that, I will have 1363, and that will end up being 15,000. So I can say that the present value of 15,000 in 3 years' time is 11269. These figures of 1126.9, 1363, and 1239 are the interest that accrues over that period. So in any given scenario, when you recognize this, even when we continue doing financial reporting, you will always recognize, if you like, the asset at 11269, and you will credit, if you like, the liability at 11269. And every year you will, if you like, you have this what we refer to as the unwinding of the discount, or if you like, multiply that to get here. So they give us a formula. Because A here is 3, it's not really a formula. You can see I divided 15,000 by 1.13 times, if you like, to get here. So in effect, what you're really doing is you're doing 15,000 over 1.1 raised to the power of 3. But in effect, this is the same thing as 15,000 times 1 over 1.1 raised to the power of 3. So what they sometimes give you in the exam is they give you this figure, 1 divided by 1.13, 1.1 times 1.1 times 1.1 is equal to that. Yes, times 1. And this is actually 0.75. So sometimes in the exam, you just get told, oh, the present value over 3 years is 0.75. That's your discount figure. And 0.75, you multiply that by the 15,000, and you will arrive at the 11269. So this first video was just literally on calculating the present value of that consideration, if you like, because here you have promised to pay a certain amount in the future, and we want to know what the present value is. Right? Cool, great stuff. We'll stop there and carry on in the next video.